Hello, and welcome to the UICCU No Judgment Zone Money Minute. I'm Sheri Shannon.
And I'm Liz Welch. We are both financial coaches at the University of Illinois Community Credit Union.
Hello, listeners. If you were with us last week, you learned more about what makes up your credit score and the importance of reviewing your credit report regularly.
That's right, Sheri. And if you don't want to pay to see your score, some credit card companies include your score on your statements. Or your financial institution may even offer your score on their digital banking platform.
That's good to know, Liz. So now credit reports are pulled, and listeners have used tips we shared to view and compare their credit reports. Let's discuss another item that is important to understand when applying for credit: your debt-to-income ratio.
Sheri, I've heard this referred to as DTI. It's a way lenders figure out if you can handle more debt.
You're right, Liz. It's basically a percentage that shows how much of your income is going towards paying your debts each month.
And if you have access to your credit report, you can see what your monthly debts are. Sheri, can you give our listeners an example of how to figure out their debt to income?
I'd be glad to. First, you'll add up all of your monthly debt payments, like credit cards, student loans, car loans, mortgage, and rent obligations. Then divide the total by your gross monthly income. That's the income before taxes and other deductions. Multiply that result by 100 to get the percentage.
So let's see. If my monthly debt is $900 and my monthly income is $3,000, my DTI would be 30%?
You got it, Liz. This helps the lender determine if you're a good candidate for a loan. A lower DTI is better because it means you have more income available to take on new debt.
So what do lenders consider to be a good DTI?
Most prefer a DTI of 36% or lower. If it's higher, it can be harder to get approved.
I see. And what would you suggest to improve a higher DTI ratio?
Well, some small adjustments could help. Consider paying down existing debts. If current income is not enough to accomplish this, consider supplementing with a part-time job to help.
Well, listeners, we hope this information has been very helpful as you get in the best position to apply for a loan. We invite you to tune in next week when we will talk about the different types of consumer loans.
And for more financial health resources, check out the financial wellness page at uofcreditunion.org. And remember, if you're listening, you can bank with us. I'm Sheri Shannon.
And I'm Liz Welch. Thanks for tuning in to the UICCU No Judgment Zone Money Minute on WPCD.